Let's get some reaction now from our markets panel, Managing Director and Chief Market Strategist at B. Riley Financial, Art Hogan, and Chief Market Strategist for StoneX, Kathryn Rooney Vera. Thank you both for being here. Kathryn, let's begin with you a little bit. This move by Fitch had been telegraphed a bit. We saw the futures declining, looking to go negative and then recovering some ground. How big a deal do you think this downgrade is for the markets?
I don't think it's going to be that big of a deal, but hopefully it is a wake-up call, Contessa, with regard to the fiscal responsibility of the country. I'm concerned, of course, about this. It has not been given a primary focus in recent years, and you can see that reflected in the fiscal deficit. You can also see that, which is 6.3% of GDP this year, reflected in debt to GDP of 135%, and as well with interest payments as a percent of GDP, which rose 1 percentage point over the past year. Interest payments a couple of years ago were about 10% of total expenditures. So, of course, as the Treasury yields rise, it becomes more costly to service the debt. So I think this is not going to derail the markets at all. But I would say that there are some risks going forward, not just on the fiscal side for the Treasury market, but also, for example, from Japan with yield curve control. You could get a repatriation towards Japan and JGBs out of Treasuries. And that could put additional upside pressure on Treasury yields.
Kathryn, you've been somewhat cautious here. When you see strategists raising their price targets after the kind of rally we have seen, do you think the bulls should be nervous here?
Well, I think portfolio managers should be cautious, and I think cautious investors are wise to seek hedging options. You can stay long this trade because inflation is decelerating, and that's fantastic. The Fed is already at its terminal rate, Contessa. But what I would say is look at volatility. Volatility on the triple Qs is near 3-year lows. So that means that buying protection on the subset of the S&P 500, which is 30% of the S&P 500, and that subset tech has risen 45%. You can buy some cheap insurance on those positions. You can get a naked put, for example, for $3.10 over a 3-month time period, protecting 10% downside. So yes, I do think there's momentum. Yes, there is further to run likely. I am cautious. I think that we should protect portfolios in the equity space and add to fixed income positions. I think bear steepeners are attractive right now in the fixed income space. And I do like maintenance of a position in gold as well as in cash.
Art, Kathryn, thank you for joining us on this Tuesday evening. Appreciate it.